So we've talked about a number of areas where Canadians move to the U.S., their U.S. tax issues, their Canadian tax issues. We're going to talk briefly about some opportunities and some problems that happen when people move between countries. Registered retirement savings plans, they're fully taxable in Canada when they're paid to you in the U.S., 15% tax rate. But that's where things change in the U.S. In the U.S., the only portion that's generally taxable to residents of the U.S. is the accrued income in the RRSP after you've departed for the U.S. So if you had $100,000 in your RRSP, but you put $80,000 into it and it grew to $100,000, you'd only be taxed in the U.S. on that $20,000 portion. That's very different. That means you're going to pay it typically, even though your Canadian tax rate is 15% and your U.S. tax rate may be higher than that, you'll pay very little U.S. tax on that. And that may create an opportunity because those additional foreign tax credits that you've paid in Canada, they can be used to offset U.S. tax on other types of income. Foreign tax credits are actually a fascinating area that most people don't really think about very much. Foreign tax credit arises when you pay Canadian tax on income that may also be taxable in the U.S. Canadian tax is usually higher than U.S. tax, and when those things happen, that excess Canadian tax can be used in the U.S. to offset other types of income, just like we talked about with the RRSP. Those creates opportunities. Sometimes those dollars are negligible, but sometimes they can be significant, and those are opportunities for you. Tax-free savings account also have some interesting issues associated. Of course, they're tax-free in Canada. You won't pay any Canadian tax on it, but they're not tax-free in the U.S. So you will pay U.S. tax that. And this is a question of saying is, will you pay extra tax in the U.S., or can the U.S. tax be offset by foreign taxes potentially and other types of income? So tax-free savings accounts, you should be cautious with them if you're going to live in the U.S. I certainly wouldn't put additional money into them once you're there. You know, Canadians that move to the U.S. and are contributing to tax-deferred savings arrangements like a registered retirement savings plan or even a tax-free savings account, remember the advantages you're getting on those accounts are Canadian advantages. If you're not paying Canadian tax or you're not paying very much Canadian tax, they probably don't have any value to you. They're not reducing your U.S. tax liability. So in most cases, if not all cases, they do not contribute monies to those plans after you become a resident of the United States. When you sell your Canadian principal residence and you're resident of the United States, as long as you did it in the year after you left Canada, you wouldn't pay Canadian tax. But you will be subject to U.S. tax on the sale of a principal residence in Canada. However, there are some opportunities for you here is that generally under the Canada-U.S. tax treaty, you'll only pay U.S. tax on any appreciation of your Canadian principal residence after you cease to live in Canada. So it's only your appreciation while you're a U.S. resident that'll be taxable. When Canadians move to the U.S., oftentimes they want to obtain a green card or lawful permanent resident status. That status is permanent with some limitations, but it doesn't require renewal except sometimes you need to renew the card from time to time. My general advice would be saying, don't get a green card until you absolutely have to. People say, well, isn't a green card a good thing? I mean, it allows me to cross the border more easily. I don't have to renew it. Well, it is a good thing, but from a tax perspective, a clock starts ticking as soon as you get the green card. If you have that green card for more than 7 years, more than 7 tax years, you'll become something called a long-term resident. When you become a long-term resident, then you may be subject to U.S. exit tax if you lose your status as a U.S. resident and cease being a green card holder. That can be expensive. So be cautious about becoming a green card holder, and if you have other means of avoiding it, that's what you'd normally want to do. Now, Canada and the U.S. have a lot of similarities, but here's one of the differences, and this one counts. That's something very unlike Canada. The U.S. has an estate and gift tax. Now, Canada has a tax at death, but it's basically a tax on your capital gains when you die, on the unrealized appreciation. The U.S. has an estate tax, which taxes your net worth at death. If you're a resident of Canada and die owning $1 million, you're taxed on any appreciation in the $1 million. Well, money doesn't appreciate in value, so it's still $1 million. There'd be no tax. But if you die as a resident of the United States, and more specifically as a domicile or as a U.S. citizen, that same $1 million could result in a tax of $400,000, because the top marginal rate on estate tax is 40%. Now, sometimes people think, that's no problem, I'll give away everything I have before I die, and then there won't be any estate tax. Well, you can imagine tax people thought about that too. And so, the U.S. has something called a gift tax. It taxes transfers by you during your lifetime, and the estate taxes transfers at death. They're both the same set of tax rates, so they top out at 40%. Under current U.S. law, you're allowed to exempt about $11.4 million from U.S. estate and gift tax. If you make gifts during your lifetime, those gifts will reduce the amount that is available to you exempt your estate on your death. Canadians that move to the U.S. and have an ownership interest in Canadian corporations or other corporations or entities formed outside the United States have some separate issues that they should be thinking about before they move to the U.S. Where they own more than 50% of that corporation or are deemed to own more than 50% of that corporation, it will be something called a controlled foreign corporation. Again, anything that has a special name to it, you need to pay attention. So owners of controlled foreign corporations, what can happen to them is income earned in the corporation can be taxable to them for U.S. tax purposes, even where they don't receive it. So Canada has similar rules to that. If you invest in a bank account in the Bahamas through a Bahamian corporation, that income will be taxable to you personally in the U.S. Again, Canada has a similar rule, but unless you have a bank account there, you usually don't know about that. So controlled foreign corporations have some special rules, and they all have some additional reporting requirements. Where you own 50% or less of a non-U.S. corporation, includes a Canadian corporation, and in some cases includes trusts in Canada, it may be classified as something called a passive foreign investment company. Now, the classic passive foreign investment company are mutual funds from outside the United States. Canadian mutual funds, for example, are typically trusts. Those will be passive foreign investment companies, and they have a tax regime associated with them which makes them generally unattractive to own. If you're moving to the U.S., generally we would say you do not want to continue to hold those investments because the U.S. tax treatment of them generally makes them undesirable. Naturally, you don't want to make your investments based on what the tax results are if the investment is so good, but you should be considering what the tax implications are to you, both in terms of the tax you'll pay and the additional costs you'll incur to report on those matters. So we've been speaking about the tax implications of Canadians moving to the U.S. There's issues in Canada, there's issues in the U.S. There's opportunities in Canada, and there's opportunities in the U.S. What I would hope you get from this is that you make sure you start planning your move before you move, because that will maximize the opportunities available to you and allow you to minimize the adverse tax implications which might otherwise apply.